We're about 30 minutes away from the close of trade on Wall Street, and stocks are decidedly lower. Where can you make money here after this big rally that we've already seen? To help answer that, I'm joined by Glenn Tung. Glenn is a general partner and co-portfolio manager at T2 Partners. It's a pleasure to have you on the show as well. And let's start, actually, before we get to the Fed question, which is a very interesting one. With the rally here, we've already rallied up 70% from the lows in March. You talk to a lot of guys who say money has to come back into U.S. assets, but are we going to see the kind of gains throughout the rest of this year, throughout the rest of the next decade that we have seen in the last 12 months?
I don't think so, is the simple answer. A year ago, the challenge was to stay invested. The challenge was to have the discipline to understand the companies that you owned and how cheap they were. I don't think today just being invested is the answer. I think you have to be very selective in what you're going to buy. We've never bought into that supply and demand of assets in terms of buying stocks. Just because there's cash on the sidelines doesn't mean we're going to buy stocks. We're going to buy stocks when they're cheaper than what they're worth.
So you don't, I mean, because there was a huge outflow here, obviously everybody put money in their mattresses and then bought anything they could that wasn't U.S. stocks, commodities, emerging market stocks. You don't think that money necessarily has to come back, or at least you don't drive your investment decisions that way?
I don't think it's necessarily going to happen, and if we won't invest in a company unless we think we can understand the intrinsic value, the cash that company is going to generate, and if the selling theory is the stock is going to go up because some greater fool out there is going to buy it at a higher price, that doesn't seem to make sense to us. All
right, let's talk about some. I noticed one of the stocks that you like here, you said, is ludicrously cheap. It's almost like a line from Spaceballs, and interestingly enough, it's kind of a futuristic company. It's the satellite telephone company.
Yes, Iridium is a satellite network. You can communicate through the satellite network via handheld telephones, but also devices you can put on ships, on cruise ships, on airplanes, in oil rigs, anywhere around the globe where you want to communicate. That's what Iridium services.
So a higher-end service, though, not a mass market, really.
It's a much higher, and that's the key point there. Iridium 10 years ago was a consumer product to compete with Verizon, and that was a very bad business plan. Now, a couple 100,000 subscribers, and
they went bust, and they're back.
Right, and a few 100,000 subscribers, Iridium will be a very, very successful company. When you say ludicrously cheap, it's trading at about 3 times the cash that the company generates on an annual basis.
You seem to make a lot of money with companies that have gone bust and come back, or almost come back, not quite yet. General Growth, you bought at 50 cents.
General Growth a year ago was trading at around 50 cents. Today it's around $16. Interestingly, we don't think that it's so cheap. We still don't are not selling the company. We think there's a great opportunity in General Growth. It's a special situation, so we think the downside is capped, and we think that there's probably a good opportunity to make some more money in that
bidding
company.
War here to come still?
Maybe a bidding war, but even if the company just exits bankruptcy, General Growth trades at around an 8% cap rate right now, where the competitors are trading at less than a 7% cap rate. If General Growth simply migrated to the valuation threshold of, say, Simon Properties, it would be around $25 a share.
All right, let me get quickly to this Fed issue today. It doesn't seem to be moving markets much, and maybe you wouldn't expect it to move market much today, but what does it do to the housing market, to the mortgage-backed security market over the long term when the Fed stops buying these assets, and you have to expect eventually, I mean, Ben Bernanke has said, eventually they're going to start selling them off?
Well, the market needs to have a normal supply and demand dynamic taking place. When you remove the largest buyer of the securities, presumably prices will go down, which means yields will go up, which means ultimately that mortgage rates may start to tick up. But you can't have a real market if the Fed is the only one out there participating. So it makes sense for them to be backing away.
Is it going to be a problem for the economy? I mean, will you see interest rates go up? You expect them to go up anyway, but does this add to pressures?
They have to be leaving the market at some point. And the economy is sufficiently on the road to recovery that this is a good point for them to be leaving. But yes, we think there's going to be an upward bias on interest rates, which means there's going to be an upward bias on mortgage rates. And that could cause some problems for the housing market.
Let me ask quickly, are foreclosures a disaster? Because we were hearing there could be 4.5 million foreclosures this year. Is that a disaster, or do they sell off in an orderly fashion?
Foreclosures are very bad, and they're probably going to get worse. There's 10 million homes in America that are probably underwater. These are on the balance sheets of banks and securitized formats, and those have to get their way through the pipeline. That's what all these modification programs are about, trying to clear that pipeline so the foreclosures can actually get through the system.
All right, hey, Glenn, thanks so much for joining us. Very interesting stock picks there, a little on Iridium and a little on housing. Appreciate you coming in. Glenn Tung from T2 Partners. Now we're